For those of you who don't know me, my name is Eric Brotman. I'm the CEO of BFG Financial Advisors in Lutherville, Maryland. My job today is primarily to be the host and MC for a conversation with my colleague, Dan Halla, and our friends, Ellen Platt and Steve Gale from the Option Group. Steve, I don't see you yet, but I know you're here. So we're going to let everybody join. Our topic today is advocacy, education, and aging. Don't say that 3 times fast, but we're really talking about long-term care, and not just long-term care insurance. I want this to be clear that this is not an insurance conversation. It's a care conversation, and we'll certainly cover some of the insurance-related topics today. That is Mr. Halla's specialty. But we also want to talk about care, whether it's for your aging parents or grandparents or for yourselves as you're planning for the future. So, Dan, you want to introduce yourself, and then we'll let Ellen and Steve do the same.
Absolutely. Good morning, everyone. My name is Dan Halla. I handle all the insurance here for our clients at BFG, focusing on life insurance, disability, and a sweetheart for long-term care. Not many people say that, but it's near and dear to me, and I'm looking forward to this meeting.
Great. Ellen?
Yes, hi, I'm Ellen Platt with the Option Group. We do private case management and advocacy, and in the work that we do, we're working with families who are trying to figure out levels of care and understand just the differences between them. So I hope to share some of that with you today. Thank you.
Perfect. And I see Steve might still be having some technical difficulties, so we're gonna start without him and see what happens, and that'll be okay. If we can move to the next slide, Sarah. This is our agenda for today. First thing we're going to talk about is the activities of daily living. There are 6, and we will get to those in a little bit of detail. We're also going to talk about the levels of care available for aging adults. One size does not fit all. And so we're going to talk about what type of care is available and where that may be available. There are areas of consideration when thinking about long-term care and aging, which we will cover. And then lastly, we'll talk about the expenses involved with aging and specifically financing long-term care. So if you'll go to the next slide, we'll begin here. Dan, you want to talk a little bit about the activities of daily living with which you've become quite familiar?
Sure. Yep. So when people talk about long-term care, there are really 2 main ways to qualify for a long-term care claim. One is inability to perform 2 of 6 activities of daily living. That's what this slide is referring to. Those activities of daily living are eating, bathing, dressing, transferring, whether it's from chair to bed, walker to standing, as well as toileting and moving around. So in the activities of daily living really refer to everything that you go through in a normal day-to-day life.
Move a little closer to the mic. We're getting feedback that it's hard to hear you.
Okay. So these are the 6 activities of daily living. That's one aspect that a long-term care insurance company would look for. Again, it's the inability to perform 2 of these 6 activities.
Perfect. Ellen, you want to talk about that from more of a clinical sense and add anything to Dan's explanation of what we see on our screen?
Yeah, sure. A lot of times that's the criteria that is used for long-term care to determine whether somebody is able to go on claim and actually utilize the claim. We also use that as we're helping families determine what level of care do they need. Can you stay independent? Do you need home care assistance? Maybe you need assisted living, memory care, or skilled nursing. So those are some of the things that we use as a criteria to determine what somebody needs. In addition to that, we also use what we call instrumental activities of daily living. And those are things that you need to do to kind of live independently. You may not have to do them every single day. But so those would be things like managing your medications, paying your bills, managing a calendar, just those things that you still need to do to live independently, things that have to be done to help you kind of live on your own.
Very good. Sarah, will you go to the next slide for us? All right, so here are the levels of care for aging adults. There are 8, which I'm very excited to learn about because actually I only thought of 3 or 4 most of the time. And of course, independent living is the one all of us have as plan A. We all want to age not only in place, but we want to be on our own and playing tennis and driving and doing everything till we're 100. That's not everyone's not able to do that, of course, but that's the plan. I don't know anyone, no one has ever come to our office, I don't think, and said, you know, what I'd really like is to spend a year or 2 or 10 in a nursing home. That's never happened. And so some of these things, some of these levels of care are more optimal than others, and some are more pleasant than others. And I guess really I want to go into these 8 levels. And Ellen, I'm going to start with you if we can. Can you talk about the 8 levels of care, and then we'll relate them back to sort of what we can use for financing and what we can't use for financing?
Yep. Yeah, so in terms of independent living, we all kind of know what that is. That's where you're living wherever you might. It could be a house, it could be apartment, it even could be above an above 55 community, but you're doing your own thing. You're driving, you may be working, you're taking care of your ADLs, your IADLs, you're maintaining your home, doing all those things that we do, come and go as you wish. And so that's a really wide variety of options, as you know, of what's out there, whether it's a home or you're renting or you're living with a friend or whatever, but you're doing your own thing, living your own life. So that's pretty easy. The next level of care is when we actually bring in home care, but you can still stay in an independent living kind of situation. So you might need help with the bill paying or the grocery shopping, or maybe you need help with bathing and dressing, and you have a caregiver come in to help provide provide that type of care. In terms of payment, it's usually an agency, and the costs for those kind of services are somewhere in the range of $35 to $38 per hour to have somebody come and help you with those daily living tasks.
Ellen, if I can jump in,
Yep.
home care a lot of times is also done by loved ones, by family members. And there's a very big difference. And I've told a lot of people this, there's a difference between showing up at mom and dad's place to make sandwiches and pay bills than it is to shower them or bathe them or change a diaper for Pete's sake. So home care can be done by family, but isn't always. And sometimes you're right, you use an agency to bring folks in from the outside, either because you don't have family members with the bandwidth, the time, or the geography to do that, or because you just don't want to burden your loved ones in that way. It's a very hard gig. I think the stress on caregivers is often reported to be higher than the stress on care receivers. So let's talk about assisted living. Assisted living and nursing homes are not the same. And we put skilled nursing here, but really a nursing home and assisted living are 2 very different things. So let's talk about those and describe the difference.
Okay, so assisted living is in a facility, and it's regulated by the Office of Healthcare Quality. And they provide assistance with those ADLs that we talked about, the activities of daily living. And there usually are 3 levels of care. So level 1 is a low level of care. They might help you with meals, maybe if you need them to stand by when you're toileting, or maybe help with dressing, just a low level of care. And they usually have lots of activities and things to do. Your meals are taken care of there. Your medications are taken care of. They have lots of things to do, and they usually have medical people on site. Level 2 is a little bit higher. You might need significant help with bathing and dressing and toileting and mobility, and people are there. You still have that same kind of care scenario. And then level 3 could be almost custodial care, as long as you don't need really high level, significant skilled nursing, which we'll talk about in a minute, where you might have monitoring equipment and you might have, need a high level physicians and nurses and people with all kinds of medical background and training available on site. So assisted living usually is 3 levels of care, usually paid privately out of pocket. And it's an all-encompassing, they take care of all your activities of daily living. If you need to go out, you might get assistance from family members or even professional home care to take you out to appointments if you don't receive your care within the facilities. There's lots of options and lots of choices for that. Then we have memory care, which is often done in an assisted living. So you still get all the amenities we just talked about, but it usually is a secure area of the building, because that is kind of kept for people who have progressed with dementia, and they may be wandering, they may have some behaviors that need special training to manage, and they usually have many more hours of engagement activities and programming to keep them busy during the day, keep them occupied and keep them, the ratio, patient to staff ratio is lower, and need a lot more cueing and guidance in your day-to-day activities.
So there is a difference, I believe, between dementia, Alzheimer's, which is a well-known form of dementia, but not the only one, and then cognitive impairment. Is cognitive impairment and dementia, are those are they the same? Is there a clinical definition or a medical definition that makes them different?
Yeah, so there are some screening options that you do, but it really is, you're looking at their function. How are they able to function independently? What do they understand? Do they do those higher level cognitive things like organizing your day and planning things on a calendar and paying bills? Take some of those higher level cognitive functions. So I'm glad you said that, though, because a lot of people don't realize that there's that area of mild cognitive impairment. A lot of people think either you have dementia or you don't. You're normal or you have dementia. And there is a large window in there where people have mild cognitive impairment. And it can, as it progresses, will get more and more difficult to do those daily tasks that we talked about, or just remembering things, and your short-term memory might start to go away first. You might remember something from a long time ago in vivid detail, but maybe don't remember if you saw your daughter this week or what you had for breakfast. So when we assess, we're looking at how are you functioning on a day-to-day basis? How complicated, can you retain information? Can you look at something and understand what it is or explain what it is and things like that. So there's, pretty complicated. There's low-level screenings. There's very high-level cognitive assessments that go into really different functions of the brain, because different areas of the brain are used for different tasks.
Okay.
So that,
Before we jump to the next section, sorry to interrupt you, Ellen.
yeah.
Before we move to the next section, Dan, talk a little bit about the difference in the long-term care insurance world between an ADL claim, or an activity of daily living claim, and a cognitive impairment claim.
Sure.
But get close to the mic, though.
Sorry about that.
It's his first time. We'll go easy on him.
There's a significant difference, especially in what the insurance company or the claim evaluator will look for. In the inability to perform activities of daily living, as well as a potential cognitive impairment, the one commonality between them is a review with a primary care physician, looking at medical records, and identifying when the assistance is needed, or when it initially started. So from a claim perspective, if you're unable to perform any of the two of 6 activities of daily living, that can start the process for when a claim is approved. And that could be a year ago, it could be 5 years ago, depending on any care that the resident or the patient would have received. Same thing with the memory care. They're looking at medical records. They're communicating with the doctors and the family, and they're doing their due diligence to check back in to see when this started. And that way, when we get into the long-term care insurance or extended care insurance planning, if you have a partner with an insurance company to help you out with a potential claim, they can retroactively or backdate to help satisfy some of those requirements for a claim.
Great, thank you. Now, Ellen, skilled nursing and nursing homes are not the same. That's not, I'm not going to call it a typo, but we wanted to talk about nursing homes and assisted living. And then there are different levels of nursing, intermediate care and skilled care and so forth. Can you differentiate between the two for us a little bit?
Yeah, so skilled nursing is much more like an institutional feel, more like a hospital. They have lots of medical equipment and lots of people at different levels of medical backgrounds. So skilled nursing can do that custodial care, can take care of somebody, whether they have cognitive impairment or whether they, are physically mobility challenged. But a lot of times it's also people who maybe need ventilators, they need trachs. They maybe need they need to have their blood sugars checked every day. They may be incontinent. They may have a lot of other things that where they need to be constantly monitored, whether it's cognitively or physically. So usually it's a higher level of clinical acuity where they're going to be needing that extra care. So if somebody can be cared at the assisted living level, that's best practices, because you want the least restrictive environment for somebody to live in. But if they need that significant level of care, you would look at a skilled nursing facility.
Okay.
Now, a lot of skilled nursing facilities have attached to it subacute rehabilitation, where people can go for a temporary period of time for physical therapy, occupational therapy, speech therapy, and other medical wound care, things like that. So that is often in a skilled nursing facility, but in terms of payment, that's not to be, that's paid by Medicare if you are coming out of a hospitalization and you just need a little bit of rehab to get yourself stronger to go to the next level of care. And that could be any of the levels of care that we've talked about so far. It just depends, again, on ADLs, how well they're functioning, what their day-to-day needs are.
Got it. And we're going to get to Medicare and Medicaid in a little bit today, but continuing care retirement communities, people throw out CCRC like it rolls off the tongue, but there's also over 55 communities, which are predominantly independent living communities for residents 55 plus. And I think there's probably some overlap there. Can you talk a little bit about what a CCRC is and how it differs from a traditional 55 and up community?
Yeah, so the CCRC, or continuing care community, retirement community, or you also hear life care community sometimes is used. And that is usually a campus that has all the levels of care that we talked about. So most of them require that you come in at the independent living level because it's based on actuarial data, that's what decides how they're going to be charging. But you come in at the independent living level, and if you need higher levels of care, then you progress through the campus to assisted living, memory care, skilled nursing. If you need rehab, you can go in for physical therapy and that kind of thing. Excuse me. An above 55 retirement community sometimes stops right there. You're really still independent living. And if you need other levels of care, you could sure bring in home care, or they might have opportunity for meals and things like that. But if you're progressing through the levels of care, you probably will have to leave a 55 plus community because they don't have all that medical staff on site. So the
Got it.
CCRC allows you to go through all levels of care, stay there, really until the end of time.
And with a CCRC, there are different ways to enter a CCRC, kind of like there are different ways to enter a home. You can buy it or you can rent it. In a CCRC, there are facilities where you actually pay an entrance, or you buy an apartment, or you have a significant down payment and then have the cost of care, versus the type where you don't have that down payment, but you have an elevated cost of care that essentially includes rent. Can you talk a little bit about the difference between those kinds of facilities?
Yeah, it's the contract that you decide to choose. Some have both contracts. There's A, B, and C contracts. One is a very large upfront fee, and you pay the same monthly fee no matter how much care you need. C is where you pay a smaller fee, but your price goes up monthly as you get more care. So it just depends on the contract that they offer, the contract that you decide to take. And the B is sort of a hybrid, and it really is who's taking the risk of the care or the cost of care.
Okay.
So it depends on what they offer and which one you decide to take.
So it's hard prognosticating as to which one is better for a loved one, or in our case, for a client or their family. It's hard to do because we don't know our own mortality. We don't know our own longevity. And certainly there are some facilities, I presume, that have only one type of contract. Is that true? So some facilities are only a type A, for example, and that's it. That's their business model. Do some have multiple options within their walls?
They do.
Okay.
They do. Some have multiple options, and some also have a refundable piece that if you pay a lot more money at the beginning, You
Mhm.
may be able to get more refunded at the end if you move to California to be with your daughter, or you pass away and there's still money in that initial upfront fee.
Mhm.
But there are some that's a very low fee and you're just not going to get a refund at all. So again, it's really important to do due diligence when you're looking at this type of community. There are lots of pros and cons. The pros really are there's lots of activities, you won't need to leave. And the model is that if you run out of assets during your time there, a lot of them have philanthropic entities that will allow you to stay there in spite of the fact that you've run out of assets.
Got it. And the next option here is hospice. And when I hear hospice, I think about the very last stage of life where you sort of go to be kept comfortable and to be allowed to pass away with dignity. Am I reading that right, or am I missing something?
So no, that's what a lot of people do think, and that is true. But there's much more to hospice than people think. A lot of people think it's the very end of life. It means everything's done. Um, to be eligible for hospice, there has to be a physician saying that there's 6 months or less of
Okay.
life. But I have seen people outlive that time frame and they get recertified to be able to continue in hospice. May not be an imminent death, but because of their diagnosis or because their circumstances, they could potentially die. But we see that they're still declining, they're still losing weight, and you can still remain in hospice and get comfort care.
Mhm.
What I do want to say is a lot of people think you go to hospice, you go to a brick and mortar facility where you receive that end of life care. And that's possible. But more often than that is hospice comes to you, whether
Okay.
you're in independent living, you're in home, having home care, you have assisted living, you have memory care or skilled nursing. You can be in any of those facilities or a continuing care retirement community, and hospice will come to you. And that is paid by the Medicare benefit. But the distinction between whether or not you go to a hospice or hospice comes to you, really the only time you go to hospice, to a facility, is when you have pain that cannot be managed at a lower level, or there may be behaviors that can't be managed at a lower level. You can also
Got it.
go to hospice for a short period of time if a family member needs respite, and you can go there and receive the care and then come back home for the rest of your hospice care.
Got it. Now you use the R word, respite. Talk about respite for aging adults.
So respite for aging adult is really for the family members, for the caregivers who are taking care of people. And so there are respite options by bringing in home care, so you don't have to be the person always providing the care. Or you could go to an assisted living or memory care facility for, say, 30 days. And you will be there as if you are a assisted living resident. You get absolutely all the services that they offer, all the other ones, but it just is for a temporary time period to allow family to go to a family wedding in another state, or maybe a family member needs to have surgery of their own in a recovery period. So you know that this person is getting the care that they need while that family caregiver is not available.
Terrific. Sarah, let's go to the next slide. And again, if anyone has questions they want to put in the chat to Sarah, she will interrupt us. She's loves to interrupt me and has for years. Let's talk
My
about
favorite thing.
let's talk about the core areas of consideration here. And this is where you need a team of experts, a team of people, a team of loved ones, and a whole lot of different disciplines to come together to make the right decision. These are hard decisions. I mean, for those who've been faced with this for their parents or grandparents or a spouse, it's an incredibly emotional time, an incredibly expensive time, and incredibly stressful time. So can you talk a little bit about how these things come together and how they each play a role in that decision?
Yep. So as a care manager, we're often at the hub of the wheel with the family and the client, and we're helping to guide them on decisions. A big part of our job is education and helping them understand their options, what's available, and how can we make the situation better. We often get the calls when somebody's declining and family is panicking, or there's been a medical emergency. and family doesn't know what they don't know, and they're coming to us for guidance and information and support in terms of making these decisions. So when we're working with the family, we're looking at these 8 core areas. We look at what is their chronic health conditions, what kind of care do they need, what level of care do they need. There's a piece of the finances, because any kind of care plan that we're creating, we want to make sure that it's sustainable over time. If we find this, Cadillac facility that costs thousands and thousands and thousands of dollars a month, and you can only afford that for 2 months, that doesn't make sense. We want it to be sustainable over time. We look at housing. Maybe you're still living in independent living, but you need a house that's more accessible, or modify the bathroom so that you can still take care of your daily functions. We look at what kind of family resources do you have? Is the family close by and can they help? Or maybe they're in California and they can't be here day to day, or they can't be here at a moment's notice if there's some type of emergency. So we look at the psychosocial supports. What local resources are available to help support this person? Do they need Meals on Wheels? And maybe there's some benefits that we can tap into. Maybe there's some home care companies or other support services. We do a lot of advocacy. If somebody ends up in the hospital and people are waking them up every couple of minutes and poking and prodding and throwing information and papers and phone numbers at them, it's very overwhelming. So having an advocate there to help you through those transitions of care and be another set of eyes and ears as you're receiving information from the physicians, we get to better understand what the needs are, and that helps inform that care plan that we're talking about. I always want to make sure people have their legal documents in place. Is there a person who is able to make medical decisions for them or financial decisions for them in the event they're no longer able to do that? What are their wishes? What kind of care or treatment do they want or not want? There's no right or wrong answer, but it's the kind of thing that you need to document and discuss with your power of attorney and the people who are going to help you at a time where you're no longer able to make those decisions. They can carry your wishes forward. And then the other area that we do is crisis intervention, because as I mentioned before, that's often when we get the calls. There's been a medical event, mom fell, broke her hip, had surgery, has to go to rehab, and she's being discharged from rehab now, and they're saying she can't go home. What do we do? So we're constantly coming in at a time that is high emotion, high acuity, and needs lots of information, education, and stabilization.
So some of these things happen at the moment of crisis, as you mentioned. A lot of these, though, you can plan for well in advance, a generation in advance. Certainly the financial, making sure that you have certain ducks in a row well in advance for the possibility of longevity issues or health issues or care costs. Housing's a decision that you really ideally don't wait until you're 83 and suddenly have an issue to decide. Are you in a home where you can age in place? And that's a question to ask at 60 and 65 and 70. Are you in a home where you could age in place, where if your health changes, your needs grow, can you retrofit? Do you have a master bedroom on the first level? Do you have a lack of stairs where you're going to be fine in a rancher or in a condominium? Do you have access to all the different things that you might need at home? Or is a move going to be imminent at some point and maybe you plan for it in advance? Certainly family, the best recipe for success here, Ellen, in my opinion, certainly in our experience, has been communication with loved ones. What's important to you? What would you like to happen? Because there can come a point where you can no longer make those decisions. And so, of course, that speaks to the legal end. You do your legal documents in the event of an incapacitation or or becoming incompetent or what have you, and you need some additional help, but you have to do that in advance to name the right people and to state your wishes while you're still cognizant and able to do that. And then from a health and disability standpoint, I've often said one of the secrets to the happiest retirees is that they maintain their health, because without it, I'm not sure it's extremely difficult to enjoy your retirement if you're not maintaining your health along the way. So am I missing anything in terms of the pieces of this that can happen in advance? Certainly some,
No.
how about some resources? What about things like if you're a veteran, if you've served in our military, or if there are other benefits, not just locally, but maybe nationally? Is that something I presume that you plan for in advance?
Yeah, I mean, you can, and there definitely are benefits and services and programs available for veterans, and some of it's financially based, and some of it is just once you need care. So it's really important to see what is available. There's some county programs, there are some programs that are specific to specific disease states. Like, for instance, the National MS Society has its source information and resources. The Alzheimer's Association has information on Alzheimer's and all types of dementia. So there's lots of programs like that available to help you either navigate with information and resources, and sometimes with some funding.
So let's shift to the next slide. And Dan, I'm gonna pull you in here because there are a number of ways to handle the financial impact of long-term care. And so let's just begin real quickly with what are the 5 ways, and then we'll go into more detail and you and I can play off each other a little bit. But let's start with what are the 5 ways? I know they're on the screen. Explain what all that gibberish means.
Sure. The misnomer of self-insuring, a lot of people think, what amount of total assets do I need to self-insure myself for a potential long-term care claim? And if you're single, then, and you don't have any heirs, that might be a smaller number. But if you're involved with someone else, if you're married, if you have family that you want to leave assets to, that self-insure or self-funded number is going to look a lot different. So the self-insuring aspect is taking any long-term care insurance, extended care insurance policy, or additional bucket of funds out of the picture. How many assets are you planning to spend for long-term care? The second here is traditional long-term care, or LTCI, which is the long-term care insurance. That's typically what we found as the first generation of a long-term care insurance policy. It was traditional. It was essentially rent. There was very little, if no death benefit or return of premium. You would pay, your premium, and if you never needed long-term care, there wasn't really anything available to you on the back end or to your family. Then we moved into what I like to refer to as a Generation 2 product. It's life insurance and a long-term care hybrid. So it's saying that if you don't use long-term care, but you've been paying for it for X number of years, at least you're going to get something back, or your family will get something back in the form of a death benefit, most likely. The fourth, it's very similar to the Generation 2, but it's an annuity component. So for those that can't qualify for traditional or linked underwriting for long-term care, some annuity products out there have what's called an enhanced benefit or an enhanced income provision. It's not tax qualified long-term care in most settings, but it is an additional source available to those who maybe might not qualify for traditional long-term care. And then, as we'll touch on more, Medicare and Medicaid, available in some settings. How much is it available, and how beneficial is it for your situation?
So self-insuring, there are only 2 kinds of people that I'm aware of for whom it makes sense to self-insure. Those are people who have so much wealth that they don't care. And even there, one could argue, but protect your assets anyway. But nonetheless, if you're wealthy enough that you don't care, that's fine. You can stroke a check for $10,000 or $15,000 a month for 5 or 10 years and not think about it. Then you really don't have to do long-term care insurance planning. And the other group is at the other end of the spectrum, folks who really can't afford to do an insurance care, and they're going to be out of money and potentially be a ward of the state in one way or another, or be on like last resources and some government assistance. Now,
Right.
I'm going to jump out of order here and talk a little bit about Medicare and Medicaid, because Medicare is health insurance for people 65 plus, but it is not long-term care insurance. The benefits here are extraordinarily limited. If I'm not mistaken, there's a benefit for 20 days and then another one that goes on till day 100, and it's extremely limited. And so for people who think Medicare is going to take care of them, Medicare is not for long-term care planning at all. That is health insurance, not long-term care. Medicaid is essentially welfare for folks who are at a medical need in their lives where they are out of money, And the various states have funding that they are essentially paying the bills for their residents who are out of money. Um, there used to be a lot of shenanigans. Frankly, a lot of lawyers and financial advisors years ago were trying to do Medicaid planning where they would deliberately bankrupt grandma so that she could get some benefits through Medicaid so that the family could keep the money instead of grandma spending it. I would say that the IRS and Congress is very well onto this now.
Mhm.
And that it is, I'm not going to say it's impossible, but it's much less favorable, and it's something we don't see very often. I still think there's a great case for lifetime giving and other things to protect some assets and preserve them, but I don't see Medicaid planning as something that happens very often. Ellen, do you see that? Do you see that with folks who come to you where they've either deliberately qualified for Medicaid or they're attempting to, probably when it's too late?
When we see it most often is when somebody is running out of assets and they're at the assisted living level and they're progressing to that next level of care. So they need skilled nursing and they can get eligible for medical assistance, which will pay for their care in a skilled nursing facility. But it's a little bit difficult because you have to require skilled nursing level of care. And there is an evaluation that the state of Maryland does to say yes or no, whether or not you actually require skilled nursing or if you could be cared for at a lower level of care.
Got it. So Medicare is not long-term care insurance. Medicaid is truly a last resort for folks who are out of money. We talked about self-insuring at the high end where you have enough money you don't care, or at the low end where you're going to wind up on Medicaid someday if you wind up with a long-term illness. Dan, you mentioned something interesting, which was about having a spouse versus not a spouse and having kids versus not a kid. Some people really want to make sure that they're leaving a legacy financially to their family, and that means that you're in conflict with spending your own money on care. Others, maybe if they don't have a spouse or a significant other, if they don't have children, if they spend it on their care, they spend it on their care, and they feel differently about it. So that's some of the psychology around the money issue. What do you see most often? Is there a trend? Are you seeing anything change? In the last 5, 10 years, have you seen a shift at all in the way people are thinking about this now that it's more mainstream?
Absolutely. When I first started here at BFG, it was traditional long-term care insurance, and it was from a few different companies. There has been a significant shift to the hybrid, whether that's life insurance or the annuity hybrid for long-term care. And again, I mentioned for the annuity, it's really the solution for those that can't qualify for medical underwriting for long-term care. Might have some other assets available, funds in an old retirement plan or something that's been set aside. But the main point there is the uninsurability aspect. For the hybrid insurance, you said it exactly. Families like to have a way to leave a legacy to the next generation, whether it's their kids or the ones that they love even more than their kids, their grandkids.
Right.
They want to move assets to future generations and help out their family line. That's one way to do it. And we've definitely seen a shift in the number of policies shifting from traditional to the hybrid setting.
So I will equate traditional long-term care insurance a little bit like auto insurance.
Mhm.
You don't buy it so that you can go have an accident and try it out. You buy it in the hopes that you never need it. And it is the least expensive, at least from a premium standpoint initially. It's the least expensive way to fund it. But am I correct that there are no traditional long-term care contracts in existence today that have a guaranteed premium or that have an end premium date? They all have some kind of potential escalation if the state approves the insurance companies raising rates, and that's happening in double digits regularly?
Um, Close. There's one company that I'm aware of, but there's a lot of speculation, and there's a lot of structuring involved in that. You can structure it for different types of pays, different lengths of pays. If you do a single premium on a traditional, I believe there's one company that does allow it, but it doesn't allow the death benefit component. So if you're funding upfront in a very large sum of assets, most clients are going to want that potential reimbursement to the next generation.
Well, yeah, I mean, you're taking some financial risk at that point. If you're writing a six-figure check with the idea that this is covered,
Mhm.
but then you die crossing the street next Wednesday, that money's gone in that model. I don't know very many people who sign up for that. Most folks want to know that they're at least hedging their bets a little bit from a multi-generational standpoint. Now, I will tell you, and this is a true story, that my mom and her husband bought long-term care years ago because I essentially threatened them that if they didn't, I was going to buy it for them and complain every Thanksgiving. And that's a true story. The idea being that I've said to both my parents years ago, as a young professional, I said, you don't have to leave me a nickel, but please don't have me responsible for your bills. I'm going to have my own family and have my own stuff. And so this is sort of one of those things that one generation does for the other. And sometimes the resources aren't with grandma. Sometimes it makes sense for kids to fund this for their parents as their own hedge for not only the potential for inheritance, if that's important, but on the flip side, to not have the filial laws jump in. And I know that's a loaded term, but filial laws are states that are trying to recoup some of the Medicaid payments that went to folks from their kids when they die. And that's a very scary, very slippery slope to think that you might be on the hook for your parents' care forever. It's one thing to care for your kids when they're minors. It's another thing to be on the hook for your parents legally. And so that's something to watch from a legislative standpoint. But at the end of the day, the hybrids feel like, and that's what I did. I did a hybrid, and I did it when I was 45. I think 45 is the sweet spot, excuse me, for some of this planning, because if you structure a hybrid, you can structure it where payments are over by 65. And so for me, this was something I don't want to be writing a check for long-term care when I am no longer working in the capacity where I am, whether that's retirement or whether it's part-time or what, who knows what I'm going to be doing. But that it was important to me. And we've seen with various families, the incredible hardship of having somebody 82 or 84 or 87 still writing checks for long-term care. There even comes a point where you say, does this even make sense anymore? Right. Because the premiums can get so absurd. So how do you walk folks through the discussion, assuming they're able to be underwritten, the discussion of the traditional versus the hybrid? How much more expensive is the hybrid really? And when does one make more sense than the other?
My favorite answer is it depends. We do, every time we look at a potential long-term care insurance situation for a client, whether it's prospective client or it's a client we've had for a longer time, we always compare and project the cost of a traditional long-term care policy, Excel spreadsheets, and looking at typical claim, we can guess or estimate anywhere between age 80 and 85. That's what we use for premium calculations. We compare that to different options, whether it's a 10 or a single pay where you lump sum fund it, a 10 pay, 15, 20 pay. There's a bunch of different options out there to structure the payment to line up with the various times of your life, whether it could be you want to be done by the time your kids are out of school, or you want to be done by the time you're retired, or any number of years that you decide. And we'll show this is what after, 30, 40, or if you pay until age 80, this is what you can estimate without any potential rate increases. And that's the other thing about traditional long-term care is that the premium's not fixed. Right. So you might have a $3,500 or $4,000 annual premium now, but when you're older and when maybe your funds are limited and you're on a fixed income, that can become prohibitive, and you might scale back on your benefits, or you might drop the policy altogether. So we'll show that comparison and say, look, here's what you could potentially spend, or this is a given. This is exactly what you'll spend, and you know it from the start.
Alan, talk a little bit about the folks that you work with who do have some form of long-term care insurance in place and those who don't. Is there a profound difference in the process? Do you have more options if you have the insurance in place? Does it almost not matter because it really is more of a personal decision, or what does that look like?
I really feel like the people that have long-term care insurance policies, I've seen many lives be changed because they're able to be cared for at a higher level or better quality level of care. So for instance, if you have that extra funding available on a monthly basis, when you need care, you can go to a nicer facility or something that has more amenities and things that you want. And it really is about the quality of life. It also allows people to stay at home longer. If they want to stay at home and just bring the care in, it gives them that opportunity, because private duty home care can be expensive if you need 24/7 care. or even just a lot of care in a given day. So it allows you to extend your ability and stretch your assets longer to be able to have a level of care that is what you would choose.
How often, and this is for both of you, how often do you all see someone, a senior who has their home paid off, and it may be one of their only assets, and they need to tap into that equity for their own care? There are a lot of different financial strategies and ways to do that, and ways to create income from your home, whether it's got a charitable component to it, or whether it's simply an annuitized option, or reverse mortgages, or all those kinds of things, as opposed to just selling it. My understanding, and correct me if I'm wrong, my understanding is you're allowed to keep your home and still qualify for certain benefits. But if you sell your home, it becomes cash. You could actually no longer qualify. Is that true, or has that changed and I missed the memo?
Yeah, I mean, I have seen people sell their house to be the down payment for the continuing care retirement community. I have seen people use those funds for different levels of care. I have seen them preserve their long-term care benefit for later when they really need it. So, that really is a great question for a financial planner and an attorney to help
Mhm.
you when it comes to that. That's more of the Medicare or Medicaid planning that you want to do, is so you avoid getting to that level early on in the process. And again, it's all about communication, planning, knowing what your wishes are, and being able to educate yourself on the options. So you're not making a knee-jerk reaction at the time of a crisis.
Well, and like everything else, I would also assume it has to do with your family situation. Is this a home that's been in your family 3 generations that you want to keep? Or is this a house that both of your kids are now in their 60s and they're not coming back to wherever you're from, and they don't want the house? And
Yeah.
so there's a lot of personal and family discussion around that. It's incredibly emotional when parents sell the house that some kids grew up in. And for folks who've been through that it's sort of a weird dynamic to say, hey, wait a minute, I've been visiting mom and dad for X number of decades in this house, and now they're not there anymore. And I think it's not to be selfish as a generation 2 human there, but that's a hard thing. And maybe you want to keep your parents in their home as long as possible because it still conjures up something personal for you also. So we bring a little emotional baggage to every decision we make. Let's not kid ourselves. And that's certainly one of them. I'm going to ask Sarah to flip to the next page. For those of you who take out your cell phone, take a picture of this QR. I wrote a book years ago called Don't Retire, Graduate. The newest edition came out this year. And I repurposed the chapter on funding long-term care. Do not tell J.K. Rowling, because I think this is probably Defense Against the Dark Arts of Aging felt like a good idea, but don't let the folks at Hogwarts know about it. But nonetheless, it's free. You can download it, and it goes through a little bit more detail about some of the insurance options, some of the non-insurance options, and some of the decision points that need to get made. We're right up against 10:50, which was what we wanted to do in terms of timing. We have up to 10 minutes for Q&A. I see that there's a lot in the chat box. Sarah, were there any questions in the chat box, or if anybody has them now, this is a great time. You've got folks who understand this industry from very different angles and perspectives who can weigh in. Sarah? Okay. Sarah is either on mute or...
She's on mute. She's new at this. She's never done this before.
Oh my goodness.
Zoom is new technology. Okay, guys?
Yeah, sure.
What are some of the common misconceptions when it comes to like long-term care and the insurance?
Misconceptions?
Yes.
I think the first misconception is that it's so expensive no one can afford it, which is not always true. And sometimes it's better to have a little bit than none at all. So you don't have to insure against everything. So literally no one out there it needs to have so much insurance that they've insured against every conceivable risk and every possibility. You just need enough, in my opinion, insurance to offset the assets you do have, to provide you with the ability to age with dignity. Am I missing anything from that perspective?
I would also add that, let's say you have a conversation with someone and they're needing to go into a facility, and you say, oh, okay, well, How are you going to pay for it? Oh, I have a long-term care policy. It's going to cover everything. It most likely won't cover everything.
Yeah.
You are limited to certain benefits, certain maximums, certain types of care, especially with the older long-term care policies, the Generation 1, the traditionals. Most of them didn't cover home health care. It was only nursing, skilled nursing facilities. So I know there are policies out there because I deal with them on a weekly basis. The newer policies do have the language in there for home health care or home modifications. If you need grab bars in the shower, if you need a ramp for your home or a hospital bed. So that's a big misconception that I have a
How
long-term
about an
care.
elevator?
It depends. I've even had conversations about a pool.
A
And we
pool?
need handrails to get into the pool for
Oh,
therapeutic.
all right. I thought you meant to build a pool because it was good for.
No,
I was going to say, what kind of policy is that, and why don't I have one? All right.
we can look at it.
I know there's some other questions. Thank you, Dan. What else came through, Sarah?
One person is a little bit confused between the difference between long-term care and a variable annuity and long-term care with insurance. So those different funding options.
I'll take a stab and then Dan will correct me. A life insurance policy with a long-term care rider or endorsement on it is a contract where essentially one person or a couple buys a life insurance policy that allows you to spend essentially your own death benefit on your long-term care. So it amplifies the amount of money you have if you need care. And there's, like every insurance policy, they're a little booby trapped and you have to sort of check out the fine print. But the premise is that if you need it for long-term care, the long-term care benefit is greater than the death benefit you've bought. But if you don't need it, or if you only need it for 3 months and there's money left over in the death benefit, that still goes to your heirs. So that's on the life insurance. And what's nice about that, and candidly, that's what I own. What's nice about that is A, I hope to never need it like everybody else and would rather leave it to my daughter. But B, because it's life insurance, it can have a level premium that doesn't change. And that makes me happy. I like certainty over uncertainty. The annuity piece is a little different. The annuity piece it's not actually long-term care insurance. And it is not something that requires underwriting because it's not traditional insurance. What it is a benefit, an income benefit, whereby if you're in a facility, and I believe all of these are a facility, I don't know if any of them are home care, but you can correct me if I'm wrong, but generally speaking, if you're on a long-term care claim or you have what would have qualified for a long-term care claim had you owned the insurance, the benefit being paid to you by the annuity carrier is amplified, sometimes as much as double. So if you were to have an income stream and it's $2,000 a month, but suddenly you need to be in a nursing home or assisted living facility and you need skilled care, the $2,000 a month might revert to $4,000 a month for a year or 2 or 5 or forever, or it all depends on the type of contract you're looking at. So make sure you understand what you're looking at. Ask the questions. These contracts are so complicated. They're 100 pages long. It's an embarrassment. But make sure you understand not only what you're attempting and what makes sense and what you're buying, but also how it works, because all of these, if used improperly, will blow up in your face. And that's where you hear the horror stories on the news and such. Dan, you have anything to add to that?
The only thing I would like to add is the insurance industry in general is ever changing. So whereas Eric communicated the point about being confined, where it's a confinement to a qualified care facility, could be hospice, could be skilled nursing. Each company has their own specific definition, and it's going to change by the time that you need a claim based on the underwriter or claims evaluator's perspective on it. Now there are a few companies and products that have changed to allow for inability to perform 2 of 6 ADLs. So the ADLs that we talked about earlier, they're revamping the definitions, they're making it more inclusive, and it's just something that always changes. But to note, if you do have a policy, any changes that happen thereafter, it's not going to negatively affect you. It's not going to bring you back and hurt you in any way.
Dan, I don't want to hurt your feelings because I know you're in the insurance industry. I don't trust insurance companies as far as I could punt them.
I don't either.
Remember that insurance companies are not nonprofits. They are in the business to make money. And when there is a gray area regarding a claim, an insurance company can become very combative. And so having experience and having some advocacy, which Ellen talked about from a care perspective, having some advocacy from an insurance company perspective is also sometimes valuable because let's face it, they would like to collect all the premiums and pay no claims ever.
Mm-hmm.
It's one of the things about life insurance that I kind of like. You're either dead or you're not. But to say you are disabled or not, or you can't do the ADLs or not, that sometimes there's a gray area, and the insurance companies are not aligned with the interest of the policyholders at all times. And so just understand who you're doing business with, understand what their claims history is, read the horror stories because they exist. Like any Yelp review, there's going to be a couple of 5 stars, a couple of 1 stars, and somebody had a bad burger, but don't necessarily grab that, but look at the history of whether a carrier's been paying claims for a long time, and then be prepared for the possibility of a fight. I mean, I don't say that because I want it. I say it because it's just reality. And so have people on your team that can advocate for you. We are just about out of time. If there are other questions, here's how to reach each of us. Dan and I are happy to field questions after the fact. I know Ellen is as well. Steve, you're a man of mystery. I know you're here somewhere. But if anybody wants to ping Steve and teach him how to use Zoom, that would be helpful. Or just to tease him a little bit for missing this morning. But Ellen, any closing remarks?
No, I'd just like to thank the opportunity for being with you this afternoon. I think we covered a lot of good information, and I'm happy to field any questions at another time.
Perfect. Dan?
Good to go.
Good to go. All right. Thank you all. Sarah, thank you, despite being on mute repeatedly. Thank you for being a wonderful host as always. And for those of you who joined us, thank you for joining. I would be very happy to field any questions. I did see something in the comments saying, are these slides going to be available? The short answer is I'm perfectly comfortable making them available. So if you'll email Sarah or email one of us, we'll make sure you get them. Thanks, everybody, for joining us. Stay healthy, and we look forward to chatting with you all soon. Take care.